With the Federal Reserve cutting interest rates, the market is feeling really positive right now. I wanted to make this video specifically for those of you who feel like you've missed out on investment opportunities in the past and want to plan your future investments better. This video is also for those of you who want to start building good investment habits but are too busy with work and life. And of course, it's for those of you who are looking for a safe and effective way to beat the market. For all of you, I can confidently say that watching this video will be a fresh start for your investment journey. I'm Michael, and I'm here to help you see life through a business lens. We've been through a lot in the past 4 years. The Federal Reserve has been aggressively raising interest rates, a total of 11 times. The market was in a tough spot and people were struggling to keep up with their interest payments. But finally, the Fed has cut rates, and by a significant amount, 50 basis points. As soon as this news came out, Canada followed suit and opened the door for rate cuts. The European Union, facing economic challenges, had no choice but to follow. Soon, even China joined this global wave of easing monetary policy. Countries around the world are now trying to find a balance between controlling inflation and boosting economic recovery. This suggests that we're about to enter a new era of global monetary easing, which should stimulate the global economy and likely lead to a surge in investment opportunities. If you don't want to miss out, I'm going to share insights from the latest global wealth reports published by 3 leading authorities: UBS, Forbes, and Henley and Partners. You'll learn the secrets hidden within the investment strategies of the world's wealthiest individuals. Later in the video, I'll even share my personal investment portfolio and strategies. If you find this video helpful, don't forget to subscribe to our channel and hit the notification bell so you don't miss out on future tips for financial success. UBS, Forbes, and Henley and Partners, 3 of the most respected names in global finance, have all released their 2024 Global Wealth Reports. After diving deep into these reports, I've uncovered a harsh truth about the future of wealth. You'll either ride the wave of economic opportunity and see your assets double, or you'll be swept away by the current and say goodbye to financial security. The buffer zone between these two extremes, the middle class, is shrinking. According to the latest Forbes report, there are now a record-breaking 2,781 billionaires in the world. What's even more astonishing is that in just the past year, their combined wealth grew by a staggering $2 trillion, reaching a total of $14.2 trillion. This proves the saying, money flows to those who have it, love flows to those who are already loved, and hardship flows to those who can endure it. Why is this happening? One of the main reasons is that wealthy individuals possess high-quality assets that constantly attract more wealth from around the world. Now, here's the key question. Is there a single factor that consistently contributes to the higher investment returns enjoyed by the wealthy compared to the average person? Absolutely, there is. I've thoroughly examined these wealth reports and their websites, and I've noticed one term that appears incredibly frequently when describing the wealth of the rich: diversification. Simply put, wealthy individuals maintain highly diversified investment portfolios. The wealthier they are, the more diverse their investments tend to be. This diversity ultimately creates a positive correlation between the number of asset classes they hold and their overall investment returns. Stocks, gold, cryptocurrencies, real estate, these are just a few examples of the diverse assets that help the ultra-wealthy effortlessly grow their wealth. Think of it this way: a wealthy person's investment portfolio is like a farm where they cultivate a variety of crops: wheat, tomatoes, potatoes, and even various fruits like apples. On the other hand, the average person's investment farm often consists of just one type of crop. Not only are the returns limited, but any market fluctuation could wipe out their entire investment. There's a saying in the investment world: there's no such thing as a free lunch. It means that high returns always come with high risks. However, ever since American economist Harry Markowitz introduced the concept of portfolio theory in 1952 and won a Nobel Prize for it, people have realized that diversification is the closest thing to a free lunch in investing. Diversification is remarkable. It not only helps reduce risk, but also has the potential to boost your returns over the long term. Countless investment gurus around the world may have differing opinions on various aspects of investing, but they all agree on one crucial point: the importance of a diversified portfolio. This means spreading your investments across different asset classes. It's one of the golden rules followed by all successful investors. From Warren Buffett's famous advice, "Don't put all your eggs in one basket," to Ray Dalio's all-weather portfolio strategy, the message is clear. Diversification is key to maximizing your investment returns. You might be wondering, if diversification is so great, why aren't more people doing it? The truth is, many people perceive diversification as overly complex and suitable only for large institutions. However, this couldn't be further from the truth. I'll soon reveal the simplest and most effective diversification strategies for everyday investors. Most individual investors, including those around you, tend to have extremely concentrated portfolios. For instance, someone who loves real estate might only invest in properties and completely ignore other asset classes. Similarly, stock traders often focus solely on stocks, putting all their eggs in one basket. One surprising factor that contributes to this behavior is rooted in your childhood memories, the perceptions and biases about investing, and the market that you developed at a young age. These early experiences significantly shape your future investment preferences. Let me illustrate this with an example from the US stock market. The 1980s and 1990s were a golden era for stock market returns, with the S&P 500 index surging from around 400 points to over 2,000 points, a return of more than fivefold. Surprisingly, during this period of remarkable growth, the percentage of ordinary Americans participating in the stock market actually declined sharply, from 40% to 17%. The opportunity to build significant wealth was right there, yet a majority of people chose to sit it out. Why? The answer lies in the preceding 2 decades, the 1960s and 1970s, when the US economy and stock market experienced a prolonged period of turmoil. The escalation of the Vietnam War, the Middle East oil crisis, and a growing US budget deficit fueled rampant inflation in the US during the 1960s and 1970s. This led to widespread unemployment and economic stagnation. The stock market during this period was, to put it mildly, abysmal. Throughout those 2 decades, major US stock market indices like the Dow Jones and the S&P 500 barely moved. Imagine experiencing 20 years of stagnant growth coupled with inflation, meaning your money was constantly losing value. To make matters worse, there were a few unexpected market crashes along the way, creating an atmosphere of fear and uncertainty. Now, imagine being a child growing up during that era. For 20 years, you witnessed firsthand how investing in the stock market led to financial hardship for those around you. The word stocks itself became synonymous with risk and potential ruin. As you grew older and finally started earning your own money, would you feel comfortable putting your hard-earned savings into the stock market? Most people wouldn't, haunted by the vivid memories of their childhood. This fear and aversion to stocks caused a significant portion of hard-working American families to miss out on one of the greatest bull markets in US history. And who profited from their reluctance? Institutional investors and those who dared to go against the prevailing sentiment. I myself fell victim to the trap of single asset investing. Growing up, all the stories I heard about overnight riches revolved around real estate. This shaped my belief that wealth and financial security were solely determined by one thing: owning property. Even after moving abroad for my studies, my mindset remained unchanged. Despite being a broke student, I was fixated on the idea of buying as much real estate as possible once I had money. However, when I finally started investing heavily in real estate, things didn't turn out as smoothly as I had envisioned. While European real estate did experience a decent upward trend, over the past decade, the costs associated with owning property in Europe were much higher than I had anticipated. Moreover, the recent surge in interest rates made me realize that my overall returns on real estate investments weren't as impressive as I had initially thought. More importantly, my all-in approach to real estate had blinded me to opportunities in other asset classes, as I observed people around me generating significantly higher returns by investing in things like cryptocurrencies and stocks. I came to a sobering realization. My deeply ingrained belief in single asset investing was severely limiting my earning potential. It was about 5 years ago that I truly embraced the power of diversification. And in the past 5 years alone, my investment returns have at least doubled thanks to this shift in mindset. When you become overly fixated on a single asset class, the risk isn't just missing out on potential gains. It's the possibility of losing everything. The economic crisis that gripped Japan in the 1990s serves as a stark reminder of the dangers of putting all your eggs in one basket. In the aftermath of World War II, Japan's economy experienced a remarkable boom, fueled by its focus on manufacturing. Companies like Sony and Toyota became global giants, exporting their products worldwide and amassing significant wealth for the nation. Japan at the time was a picture of prosperity. Businesses and individuals alike were caught up in a frenzy of spending and investment. Land prices in Tokyo's Ginza district soared to an astronomical $250,000 per square meter. Remember, this was 1989. If you were a young person in Japan during that era, owning a property in Tokyo would have seemed like the ultimate dream and a surefire path to financial security. However, as we all know, Japan's economic bubble eventually burst, leading to widespread financial ruin. Countless families lost their life savings, and those who had taken on large mortgages to purchase property found themselves drowning in debt. Some are still struggling to repay those debts even today. This is the harsh reality of the risks associated with concentrated investments. Okay, let's talk about how we, as regular people, can build a diversified investment portfolio. What exactly does a diversified portfolio look like? Let me introduce you to someone who's considered a legend in the world of diversification. Meet David Swensen, the mastermind behind the Yale University endowment model. Swensen's investment philosophy is remarkably simple. He believes that most people waste their time trying to time the market and pick the perfect investments. He argues that both of these endeavors are futile because you can never get it exactly right. Instead, he emphasizes the importance of focusing on what truly matters, building a well-diversified portfolio. Back when the Yale University endowment was struggling to generate decent returns, they brought in Swensen. And what did he do? He implemented a strategy that doubled their returns simply by diversifying their investments. He didn't just buy US stocks. He invested in real estate funds, bonds, international stocks, and even ventured into higher risk assets like futures and private equity. And the results? Since 1985, the value of Yale's endowment has skyrocketed, especially in the past decade. Their investment returns have not only consistently outpaced inflation, but have also left their peers in the dust. The majority of the asset classes in their portfolio have significantly outperformed their respective benchmarks. Whether it's actively managed funds or passive index funds, Swensen's diversified approach has consistently delivered exceptional results. David Swensen's success story teaches us a valuable lesson. We should strive to let go of our investment biases and embrace diversification. Think of your money as an army. Dividing it into different units is the key to victory. Now, some of you might be thinking, there are so many investment options. I can't possibly understand them all. Besides, I don't have enough money to invest in so many different things. But here's the thing. Today's financial markets offer a wide range of user-friendly tools, such as ETFs and index funds, that make diversification accessible to everyone. You can find a diversified portfolio that aligns perfectly with your risk tolerance, age, and financial situation. Not only are these investment vehicles cost-effective, but they're often managed by professional teams who continuously optimize the portfolio's allocation. The key takeaway is this: as long as you avoid putting all your eggs in one basket, you're essentially mitigating a significant amount of risk while still giving yourself the opportunity for solid returns. All right, it's time for the big reveal. I want to share my personal investment portfolio with you. I'll break it down from the smallest allocation to the largest, covering the 5 main asset classes I invest in. First up, the smallest portion of my portfolio, around 5%, is allocated to higher risk, more aggressive investments. This includes cryptocurrencies and private equity. One interesting thing I discovered while researching the global wealth reports is that the largest holders of cryptocurrencies are now government institutions in countries like the US and China. This suggests that the nature of cryptocurrencies is changing. Of course, this asset class still carries significant risk, and I don't recommend it for everyone. The reason I have a small allocation is that I'm willing to accept the potential losses given the limited exposure. However, this small investment allows me to stay informed about cutting-edge financial trends. It helps me maintain my curiosity about the market. The second asset class in my portfolio is insurance, including both savings type and annuity type policies. As my risk awareness has grown over the years, I've realized that life is unpredictable. What if something happened to my business? What if I lost my ability to earn an income? Insurance provides a safety net for my family and ensures a certain standard of living in the future. I plan to increase my insurance allocation to around 10% of my portfolio. The third asset class is stocks. I've been fortunate to achieve an average annual return of 12% to 13% on my stock investments. Of course, this is partly due to favorable market conditions. I follow a passive investment approach, which you can think of as dollar cost averaging. I invest a fixed amount of money in stocks at regular intervals, regardless of market fluctuations. My primary holdings are ETFs and a few individual stocks in companies that I believe have strong long-term potential, particularly in the AI sector. My overall stock investment strategy is focused on diversification and long-term holding. I rarely sell my stocks unless absolutely necessary. I plan to maintain my stock allocation at around 15% of my portfolio. The fourth asset class is real estate. I'll continue to invest in real estate, but I've made some adjustments. I won't be as aggressive as I was in the past, and I'll diversify my real estate holdings geographically instead of concentrating them in a single location. My goal is to gradually reduce my real estate allocation from around 50% to around 30% of my portfolio. And finally, the most important asset in my portfolio is my business. At my age, I believe in dedicating a significant portion of my energy and focus to growing my business. While it requires hard work and dedication, my business is my primary source of income and brings me immense satisfaction. It's what fuels my passion. My business will always remain the cornerstone of my investment portfolio. I want to share a piece of advice with those of you who, like me, are deeply committed to your businesses, but also want to build wealth through investing. Many of us are inspired by the stories of investment gurus who have amassed fortunes in the financial markets. We start to believe in the allure of passive income and other investment myths. However, the reality is that building a solid foundation of active income is essential for consistently investing in assets that generate passive income. It's what allows you to ride out market downturns and hold on to your investments in stocks, real estate, or even gold. Most people have a narrow view of investments, limiting it to the realm of money. But the truth is, our most valuable resources extend beyond our finances. Our time, energy, and focus are equally precious assets. Over the past few years, I've come to view my time and energy as investments just as important as my financial capital. I invest these resources in things like building a strong team, attending courses and workshops, and expanding my knowledge and skill set. These investments have the potential to generate significant returns in the future. Your investment strategy shouldn't be confined to the narrow world of financial markets. Your work, your business, these are integral parts of your investment portfolio. Never underestimate their value.